Good morning, folks. Welcome to Opening Playbook. We're going to do our pre-show for a few minutes, and then we'll get into the live show right at the top of the hour. Good morning, folks. Welcome to Opening Playbook. We're going to do our pre-show for a few minutes, and then we'll get into the live show right at the top of the hour. For those of you who are new to trading or just new to our group, a special welcome to you to Opening Playbook. Our mission here at Opening Playbook is to be a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding. We offer market insights, timely analysis of what's moving the markets right now, trading education, helping you build real skills beyond surface level tips and tricks, and live trade ideas, real-time recommendations you can act on immediately. Opening Playbook is a free daily live webinar, and the hosts of our show are Nathan and Graham. Nathan Tucci has spent over a decade of experience trading Forex, stocks, and beyond. He's worked with dozens of leading global experts on strategy development. He's obsessed with math and systematic edges in trading. He's a creator of the Income Machine, Overnight Options, and more. He's a husband, a dad of 7, and the publisher here at the pub. Graham Lindman is an options expert with over a decade of market experience as well. He studied technical analysis under 2 of the top minds in finance. He developed the wrap order option trades for cost-effective entries, created lightning trades, moonshot alerts, NVIDIA Elite, Apex Indicator, and Newton. Now, a lot of people in the stock market education industry will tell you that trading is easy if you just know their quote-unquote secrets. That's not us. The hard truth is that trading is complex and takes time to learn, but we can make the learning process much easier. The Opening Playbook exists because a lot of traders have trouble succeeding because they believe many of the myths out there about the market and trading. We dispel those myths and equip you to become a better, more mature trader, giving you the opportunity to be more successful, whether that means using our systems, tools, and strategies, or just trading on your own. Remember, our goal is to be a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding. It's important to remember that you should never trade with money that you can't afford to lose. Nobody likes losing, but there's a difference between losing some of your investment portfolio and losing the rent or grocery money. So please, don't trade with money that you can't afford to lose. And let's be ultra clear. Any type of trading involves losing some of your trades. It's inevitable. Controlling your risk will keep you in the game, and we can help you learn structures and strategies to do just that. Our promise is that we'll be honest and transparent with you about what works and what doesn't, what you should make your own decisions about, and what rules we believe you should always follow. A few simple rules to get you going are stay calm, try not to trade emotionally, go at your own pace, it's not a competition, you don't have to keep up with other traders, and ask questions freely. We really genuinely want to help. To help get you started, we'd like to offer you some free information. Answer a few quick questions by clicking the link in the banner above, and for that, we'll give you customized content to better help you. We'll use your feedback to help improve our classes and education, and we'd like to give you a free options cheat sheet, our digital, easy-to-understand options guide that looks something like this, but a little less blurry in real life. Now, we'd like to go over some tips about our webinar platform here. It's a little different than a typical Zoom room. So here are some tips that might help you get the most out of our sessions. You can click the hamburger icon, those 3 horizontal lines at the top left, to reduce the size of the green column, giving you more screen real estate for everything else. You can hover over the video or tap it if you're on a mobile device and click the speaker icon to mute or unmute the sound. If you suddenly lose audio but the video is still playing, you might have accidentally tapped on that speaker icon. Just tap it again. In the bottom right corner of the display, you'll see maybe 1, maybe 2, or maybe neither of these icons. It depends on which device and which browser you're using. The double arrow icon will allow you to go full screen. And the square inside of a square will allow you to do picture in a picture so that you can keep the presentation running while you're doing something else in the background. But again, those will depend on a few factors. You may not see one or both of those icons. The option that I think most people should take advantage of is the little monitor icon below the presentation area. I recommend using this feature. It will maximize the presentation without hiding the chat, so you can still stay in communication and see what everybody else is typing and what we're typing as well. You can click the yellow low latency slider underneath the video if you have poor video or audio performance. It'll add a few seconds delay to the broadcast, but it will usually clear up any audio or video problems you might be having. Now, the column to the right is the chat area. The large area is where you'll read the chat messages that you and other people type. Please note, this is a group chat, meaning everybody will see everybody's messages. The bottom area is where you'll type your own message, and you can press enter or click on the little green arrow to send your message. The top green bar is where you can change tabs in the chat area. The right arrow icon all the way on the left will collapse the chat, which I generally don't recommend. You want to keep an eye on the chat. The megaphone or bullhorn icon is the tab for the announcement section. We use the announcement section to post any live trades that we take in the session, and there's always a static set of helpful links in there as well. If you haven't seen the helpful links, I highly suggest you take a look at them. Now, the double speech bubble icon is where you can do private messaging to the hosts. Can't private message other attendees, but you can private message with any of the hosts, and they can private message you. If we send you a private message, you'll see a red dot appear in this green bar to let you know that you have a private message, and you can click on that double speech bubble icon to view it. Once you've done that and you want to get back to the main chat, you can click on the speech bubble with the 3 dots in it. That's the group chat. And last but not least, the diagonal upper right arrow there will pop the chat out of the main window, so that if you're using multiple monitors, for example, and you want to put the chat on one screen and you want to maximize the presentation on the other screen, you can do that. And that's it. So once again, welcome to Opening Playbook. Don't forget to complete that survey and get that options cheat sheet. And now we're going to play our theme song, and then we will get started.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with a hawk's eye. Options in place in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with a hawk's eye. Options in place in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls on their trading phone. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor.
Well, good morning, everyone. Welcome to the opening playbook for Monday, March 2nd. Happy March, everyone. How you guys doing? Nathan and Grant?
Hey,
Can't
hey,
believe
this
it's
is this is where
March.
the big plays are made.
This is where the big plays are made. Indeed.
I love it.
Indeed. When Graham wrote that song, that's exactly what he was
Yeah, and I
thinking about.
recorded it in my
Right.
studio.
Morning, Rafi. Morning, Katura, Dave, couple other folks. I wonder if Charles is in here too. I got a couple emails over the weekend about my thoughts on. Oh wow, XLI just filled. Nice. A couple thoughts on what's going on with Iran and all of that. So I'm excited to share some insight. Obviously, not excited about war. It's pretty horrible, but I am interested in kind of getting your take and also sharing my point of view because it's a little bit different maybe than what you would expect. And then I've got a couple other things to cover and even have a free indicator for everyone here today.
Wow.
So
That's awesome.
yeah, I actually, to be totally honest, I don't have the full lesson I plan to go with the indicator because I was planning on doing that later in the week. But Graham ended up having to do a little more of the trading side of things than he usually is on the hook for this morning. So I'm gonna take charge and I'll give you the indicator today, and then maybe we'll dive deeper into it later in the week.
I love it. That sounds like fun. Yeah, I've got two master classes for tomorrow. If you guys didn't see, first off, Lotto Board members, we're gonna have our first master class tomorrow at 12:30 p.m. So get ready to gear up and have some fun there in the room. And then also 60-minute members, we're gonna have our master class tomorrow at 3 p.m. So hopefully you're a member of both. You get to enjoy both sessions. They're gonna be a blast. 60-minute. We've got some finalized updates for you guys. We've got a trade. Nate, we've been avoiding VIX under 16, which I mean, luckily as of late, that hasn't been an issue at all.
Not an issue.
We almost hit our target here. So we've been avoiding VIX under 16. We put in some rules for allocation sizes on our normal trades when VIX is above 16. So we'll be talking about that today. The scorecard that we're going to be using going forward to help you guys know position sizing. And then also in the testing, we did find a low VIX opportunity that we're going to be diving into next. So that'll be fun.
Yeah, I'm looking forward to that. I've been obviously getting at least part of the inside scoop in the channel, seeing all of Jason B's reports and updates as you guys have gone back and forth. Shout out to Jason.
He's the best, dude. He is
what an incredible asset Jason has been, just churning through the data and looking for ways to optimize that strategy. So you guys probably don't even realize what an advantage you're getting with Graham these days because of the background effort that is also going into everything that he does to make it better. So that's an awesome
I
win.
had somebody the other day who said Graham's gotten twice as smart since they hired Jason.
I appear to be. I don't know if it's mostly Jason. You guys just look and think it's all me, but no, Jason, amazing work. We're 23 of 26 this year on our 60-minute trades and up today. So
23 out of 26?
Yep.
Wow.
So 23
That's awesome.
and 3. Hopefully today will be 24 and 3.
Love it. Love it. All right. Well, we're going to start with all posting our political opinion of the. No, I'm just kidding. We're going to start with the overall market. And then I want to give a quick reminder for those of you who are new. I already saw at least a couple people who said they were new. And then I'm going to jump into this indicator and kind of trend versus chop discussion. Graham, anything else on your side before I go full blast here?
There's one thing I forgot to mention on Saturday. If you guys give me a yes in the chat, if you guys got Lotto Board access, give me a yes in the chat. One thing you may have noticed if you opened it up right away this morning, it may have been blank. What normally happens is it takes 20 minutes to let the markets filter out, settle down, because the options prices are going to be so wide. The data is all going to be wonky. So it takes until about 9:50, 10 a.m. or so before picks start populating. So if you look at it now, you should have the full dashboard of picks. But I just didn't want you guys to be worried if you looked at 9:31 and there's nothing on there. That's just because it's processing the market data, letting the market settle a bit. A lot of yeses, awesome.
That's a lot of yeses in the chat for a lot of folks. So you guys are gonna be loving that class then coming up here. All right, dude, I didn't do my buy the dip trade this morning. I wanted to talk about it during opening playbook, and this is like the fourth time I've said that, and then it just moves quick because my whole thesis here is that the market cycles are accelerating to the point that everything is happening more quickly. And we'll talk about that in a second, as it relates, to the war and other things. But let's just jump into where we are overall. This is where we are, which is stunning. Only 0.25% down in the SPY, only a bit further down in the Qs. Even the Mag 7s, which have been, weaker historically over the last, sideways chop, down about 0.4%. And then here's where you see the global index. So the global index is taking that big hit, but the United States market is a lot stronger right now. I mean, 10 times stronger if you go from 2% to 0.2% in the S&P. And then we're seeing actually Bitcoin rip up. I still have those couple thousand shares that I talked to you guys about 2 weeks ago. So I'm hoping that we can get Bitcoin back up to about 75. If that happens, that'll be a home run trade for me. So I'm keeping my fingers crossed on that. But obviously I have to manage that one pretty tightly, given that I do expect Bitcoin to go much lower before we get any kind of real long-term cycle. And then gold up as well.
An interesting note there. Gold is up today. Silver's down 3%.
I saw that the volatility in silver is getting crazy to the point where now it's not even just an exaggeration of the gold move. Now sometimes it's literally a different move altogether. Here's what I find really fascinating. Now this is actually, if you guys notice, I posted in Telegram when these were essentially all red. And what I wanted to show you is that we had a really interesting reaction this morning, because when the market has major fear or crisis, what tends to happen is everything correlates more closely together. And so you don't see like, okay, RTX and other things are up, but, everything else is down. You'll see like a very, very few instruments being up. RTX would be one of them, by the way. And then pretty much everything down, even staples and things like that. And that's exactly what we saw this morning. Everything kind of correlating to the red side. You can see XLK somehow pop back up to slightly green here, which is amazing. But everything pretty much down to the downside, about 0.5 to 1%, with discretionary taking a little bit more of an outsized hit here at 1.77, which makes sense. And I just thought, actually, this is a pretty good reaction for major fear and concern in the market, because what we saw is that we weren't getting a total risk on flush. We weren't seeing technology down 3% and staples down 0.5, and communications down 3 and utilities down 0.4. We were actually seeing everything pretty much within the same ballpark. Now, like I said, discretionary got a little outsized. That makes sense. But pretty much everything was in the same ballpark, with just energy being up, which of course that's because of supply and demand concerns regarding energy. But that made me think, okay, this is not a full risk on flush. This is just a market reacting and kind of getting a very reasonable pullback that is across the board consistent among all of the sectors. That tells me we're not getting a bottom falling out true move to the downside here. We are just getting a, hey, hold on, something happened, VIX up, little liquidity, regardless of your position, some liquidation, backing out, but nothing that is saying, okay, we are getting a catalyst for a torpedo breakdown in the market. We just never saw that in those risk on sectors. So to me, that points to a likelihood of a buy the dip, which I didn't do that. I wanted to do that live on our opening playbook session, but we've already had 0.75% move in the S&P. So we're a little late to the party, unfortunately. But I just think everything made sense for that to happen. I'll give you one more thing, kind of like I said on my thesis for why I think that's happening. First, let's just look at our heat map. I always like to look at the heat map. This is the top 100 market cap stocks, just to kind of see where they are. I'm a little behind. Again, this is last updated like 15 minutes ago, which is already going to be a decent change just because the market's moving pretty fast. But it actually kind of shows you how the market looked 15 minutes ago or 20 minutes ago, where it was RTX and Palantir and of course some of the energy companies. It was all of the companies that people expected to actually get a net benefit from a global crisis, right? Palantir, Raytheon, energy companies. Nvidia bounced back. Just I think that's more of an oversold correction. I actually held on to my Nvidia shares as well, and so I did pretty nice this morning just on a small bounce on Nvidia. That was more luck than anything else, but I just figured, okay, Nvidia's overcorrected at this point. Let's at least see if we get a midpoint bounce, similar to what I expected we would get Friday, and we didn't get. I think we'll get today. We got some of it and a little more this week. But what is really important to me is not that Raytheon and Palantir bounce. This is kind of what you would expect. That to me is not important. What I think is important is that as you get down to Meta and Apple and even Micron over here and Oracle and a lot of these stocks, Walmart and Costco, GE, go down the list, a lot of these stocks that you would not expect to hold the line. They would be on the other side of Palantir and Raytheon, and so they should be down 3% or 4%, right? They're not. They're down 0.25%, 0.5%. Even some of the more risk-on ones that you see as you get down here are down 1%. And even all the way down to the bottom, outside of some of these really ugly financials, which have their own thing going on, you're really only getting 2% and 3% to the downside, Google 2%. And so you're getting less of a collapse, Tesla 1.7, than you are actually to the bullish names up here with Palantir and Raytheon and some of the energy. So again, to me, all signs kind of point here that this is not a crazy, ugly flush in the market. It's just your typical reaction. Now, let's take that a step further here and actually look at historically what has been happening cyclically on these kind of events. So we're going to start all the way back here with Germany invades France, 1940, essentially the kickoff of World War II. Okay, obviously about as bad as it gets as far as wars go. And things were very negative. They were negative for months, and then into the year. Okay, you get Pearl Harbor the next year, and you can already see, because the market was beaten down, we were actually net positive 12 months after Pearl Harbor, which is just crazy. And as you go through a lot of these events, you can actually see, here's an example of the Iraq invasion. Okay, it was down 8%, had a bigger flush over the following, but then actually managed to be positive 12 months later. As we go through, and I'm specifically talking about conflicts right now, so I'm not really focused on things like, for example, in 2008, you would have Lehman Brothers here. Well, I'm not counting that. That's an actual financial crisis. I'm talking about things like the Russian annex, or Syria, or North Korea over here. Even the pull out of Afghanistan, I don't think necessarily is a good look at what the market was doing, because that was happening during the 2022 collapse, which had a lot of other components. But you can see over time, we've had quicker and quicker and quicker recoveries to these kind of events. And so I think that's kind of the theme of the cycle that we're in right now, is that as the market has matured and things have moved more quickly on a cyclical basis, we're seeing the buy the dip environment move faster and faster and faster, to the point now that sometimes the dip lasts an hour or a day, because people start forward thinking. They think of things like this. Okay, historically, when war happens, the market takes a flush, and then a couple months later, it rebounds. And so really after a month, we should start to buy back in. And then a couple years later, because people are more aggressively buying back in, that cycle shortens to a couple weeks. And so people realize the cycle is shorter, and after a week or so, you should kind of be buying back in on fear. Well, that buying naturally shortens the cycle again. And then after a couple of days, people start buying. And I think the environment has now become so short cycle, especially with zero DT options and everything else, that now it's like you buy the dip the day of. When an event happens, when the VIX spikes, we're seeing big money come in, and by the way, and retail money come in and just buy the dip right away. And so I think one of the things that we have to recognize in the current environment is that the cycles are just very quickly, and so are happening very quickly. And so the buy the dip kind of world isn't, we're not talking about months of market correction. We're talking about often 1 day flushes and immediately getting them green the next day. And we've actually seen that even just in the sideways market without a global conflict catalyst. We've just seen that happen in regular outsized market flush days where immediately we're seeing buyers step back in. So to me, that's kind of the broad view that we have right now. And I think the cycle that we all need to be paying attention to. It doesn't mean that the other shoe can't drop, because it can, and it probably will. But I think even that will happen in very quick bursts. So what do I mean by that? Well, the Iranian conflict happened over the weekend. The market was down about 1.7% or so at its peak negative. It opened, down 1%. Now it's down 0.1%. It's already basically gotten back to break even from the weekend. And I would think that it even has more momentum as we go into the week. But then something could happen. Another headline hits. A ship was sunk, a U.S. ship was sunk, or some casualty happened, or some headline even outside of conflict, or at least direct conflict, but something like energy markets being affected because of a pipeline or a canal blocked off, or whatever the case. Okay, you get another reaction, but then the same way, that reaction is responded to very quickly. And then a week goes by and you get another event, another headline, have an immediate reaction to that. And even that reaction gets. And so I think what we see right now in the current market is a series of very quick headlines, kind of intense reactions, and then quick responses versus the actual event playing out over the course of months, and then over the course of more months and months, reacting and responding to that. So anyway, that's what I would expect just as an overall theme here in terms of not just this event, but in general, the kinds of events that we're seeing a lot lately, especially in this very sideways market that we've been stuck in. And that's what I want to talk about next, and kind of how to plan for that. And I have a couple ideas and notes. Like I said, I don't have my full presentation ready for this. I've got some plans to walk you through this in a little more detail. But for now, I just want to walk you through how I think you can set yourself up for a little better success in the current market. And then I'm going to give you an indicator if you want to kind of use that to your advantage. Before I do that, let me just mention, for anyone who is new here, give me a quick yes in the chat if you're newer here to Opening Playbook or to our community. Maybe this is one of your first couple of sessions in either Opening Playbook or Closing Playbook, or just reading along. First of all, just want to welcome you. Thanks for being here. Obviously, you're here on kind of a wacky day with just a lot of stuff going on and reacting to global conflicts and everything else. But first of all, thanks for being here. Second of all, if you guys don't know, one of the things that we do here is Dave, our trusty host, opens this room early every day. And so every day at about 9:50 a.m., Dave opens up this webinar room, and he just goes through some basics of how the show works, how to use the platform, how to get to our free resources, because we do a ton of stuff for free here for you guys. Some classes show you how to get access to the $1 membership if you want, which is basically our way of putting tons of content into a protected members area, which our team told us we had to charge something to do that. So we charged $1 for lifetime access. So he'll walk you through that if you want. And then we also have a little cheat sheet for you, a little options cheat sheet that's totally free. Just show up. There's just a little form you fill out. You get that for free so we can connect with you. And it's just helpful so you have a little extra context for making sense of the things we talk about. So when we talk about debit spreads or credit spreads or directional options, you have that little cheat sheet. It's helpful, and you don't have to maybe get into the weeds as much or use ChatGPT as much to figure out what we're talking about, because you have that cheat sheet. So again, that's every day, just 10 minutes early. If you are newer, I highly encourage you to set up and just take that 10 minutes, because I think it'll be well worth it. All right. With
Yeah,
that said,
and thank you, David, for doing that. It's very
and
great.
thank you, David. Yes.
No problem. And Jim, the cheat sheet, when you fill out the form, the little survey that we give you as a new attendee, as soon as you fill out that form, the cheat sheet's immediately there on the next page. So I had the link up before. I can drop it in here again, and you can fill it out. Should take 1 minute.
All right. So, folks, we have been talking about this sideways market now for months, and I have my trusty box here that I usually draw just like this, that just kind of defines the tops and bottoms of this. This is the S&P 500 on the daily chart, and I think depending on how you approach the market, this can mean a lot of different things to you. This kind of chop. For most people, chop is just difficult to trade in, especially if you are more systematic or mechanical like I am. So, for example, I'm a very mathematical, systematic trader, and one of the things that means is that my most kind of common fundamental bias is that the market will usually go up more than it goes down. Okay, so if you follow me, you probably know this. I trade with a bullish bias 80% of the time. And the reason is because the market goes up more than it goes down. And so I don't want to take away the most fundamental edge of the market out of my trading. And so I include that edge of being biased to the upside because it's very helpful, okay? Because over time, that's going to be very, very advantageous to you as you build out a strategy. But of course, that means when the market gets stuck, now those strategies that depend on that bullish bias have a little harder time. And the reason it's a little bit harder, especially in the sideways markets, is because if the market is just bearish, right? If it just is going straight down like this, well, you can filter that out pretty easily, right? If you want to be bullish, but the market's collapsing, you can filter that out fairly easily. But when the market is up and down, well, it's going to give off a lot of signals that are somewhat bullish. I mean, like this looks like a very bullish signal here, and then it's going to collapse, and it's going to give off another bullish signal, and it's going to collapse, and again, and again, and again. And that's the nature of a sideways market, which is why so many people struggle. So today, I want to talk about two things. Number one, identifying when you're in this kind of market condition. And there's a couple ways you can do it, but I'm going to give you an easy one. And then number two, I want to talk about the different trade structures that you can specifically apply to this sideways market with a couple of guidelines around that. So the first thing I'm going to do is just mention this indicator. So I just built this for you. Now, I'm going to be honest with you guys. This is not some, elite, incredible indicator that's going to give you the most, timely, impressive way to calculate a sideways market versus a bullish market versus a sideways versus a bearish. It's going to give you a pretty basic version of that, but I actually think that even a very basic version of that is going to put you ahead of 90% of traders who don't even think about that market regime at all and are kind of stuck following fake signals all the time. So the way to get this indicator, if you guys use TradingView, is really easy. You just click this link. I'll post it in the chat. Just click that link. What that does is it loads up this page right here in TradingView. And then you can just click something like add to favorites. And then when you open your TradingView chart, it will now be in this indicator dropdown here automatically for you. So it's just a couple clicks. If you guys don't use TradingView, it's just a free account. I actually love trading, even though I do everything on Thinkorswim as far as my actual trading. I still use TradingView for my charts just because I like the charts and I like how quickly I can build indicators and do different things on it. So I recommend it. Certainly you don't have to use it, but I just think it's really easy. It's free. It does some things that I think are more visually appealing than most of the charts that come with, the actual trading brokerages or platforms. And so what this indicator is going to do, and I'll minimize my other stuff here just so you see only that indicator there. All it's going to do is it's going to look back at a certain range. I have the range set at 60 candles right now. It's going to use some EMAs. I have the 20, 50, and the 100. And it's going to tell you, are you in a range market, a bullish market, or a bearish market? And just to be clear, it's going to lag a little bit, right? Because we're literally using a look back. So it's not going to be like, it's not going to predict when the market's going to change. It's not predictive at all. It's just going to tell you, hey, this is kind of cemented at this point that we're in a sideways market. And so maybe be aware of that as you look for trading opportunities. Now, I have it right now using settings that are purposefully a little bit slow. In other words, it's going to overcompensate for it being in a range versus a bullish market. Like you can see here, it didn't call this a bullish market until we got all the way into August. Now, I like that because obviously I already have other things where I'm going to be a little more active, and I'm not going to wait for it to be August to actually start taking trades. But I like to err on the side of not assuming, hey, we're right back to a bullish market, and purposefully be a little bit slower on these transitions. But you can very quickly switch that. To show you how to do it again, just click that link that I opened in the chat. That opens this window here. Okay, so if you click that link, that opens this window, this link right here. And then it should have a button in the top right, which is add to favorites. And when you click that button, it actually adds it as one of your favorite indicators right away. So that then when you're viewing a chart, you will see that indicator as one of the choices. Just click that indicator and it will populate it onto the chart for you. Okay, and I have a little bit of a definition around how it works and all that underneath, but all you got to do is click that button and this indicator will show up in your favorites, and then you can click it and populate it onto your chart. So again, I have this a little bit slow on purpose, but all you have to do is click the settings in here and you can change this. You can make this move a little bit faster. You can make it so that it's more effective maybe on a shorter time frame. If you like using smaller time frames, you can do a lot of different things. You could change the EMAs, but I have it, like I said, so that it's a little bit slow, erring on the side of as we transition, I don't want to get ahead of the curve. And it basically results in longer transition periods. Okay. So if you wanted to make it more sensitive, what you would do is you would play with the percentages here. So as you can see, all I'm doing here for the definitions is I'm saying, okay, 80% of the EMA, the fastest EMA, which is the 20, 80% of the candles have to be above for bullish. At least 90% on the middle EMA, that's the 50, have to be above. And 100% of the candles on the 100 EMA have to be above. That's my bullish definition. So that's a pretty strict bullish definition. If you wanted to make it less strict, you would just change these numbers. You could say, listen, I only need 70% of the candles to be above the 20. I only want 80% to be above the 50. I only want 90% to be above the 100. Well, there you go. Now you have a much more sensitive bullish, and you can change as much as you want. I have it a little bit easier guidelines for my bearish because bearish markets just don't happen very much. And so I make it a little bit easier with a 70, 80, and 90% on the same thresholds compared to the bullish definition. And then anything else, it's going to call it sideways. It's going to call it a range market. If it doesn't fit the bullish or the bearish, it's going to call it a sideways market. And then I have it shaded, as you can see here, where green is bullish, this orangey brown is sideways, and then you're not going to see very many bearish markets. I mean, look, this is what it takes to get into a bearish market here in 2022. Now, again, you can make it a lot more reactive, but I really prefer to visually err on the side of seeing this show as a rangy market so that I'm not jumping the gun. I can still make a discretionary decision, but I'm not jumping the gun. That might not be your preference. The reason that I like it is because in a market like this, I don't want to get too caught up in, hey, we got a breakout, we got a big bullish candle, We're buying the heck out of this market. I want it to force me to be a little more patient in the exact kind of conditions that we're in right now. And I think it does a pretty good job of that. Again, not a premium indicator that you're going to use to make trading decisions in and of itself, but I think it's a good kind of mental check for you and forces a little bit of patience, in my opinion, when you're looking at a market. Now, you can use this on any chart, on any time frame, but it's really meant to give you the S&P daily view, because to me, that's going to be the best view to tell you what actual regime you're in, because the daily chart is going to be long-term enough to actually accurately define the market conditions themselves, whether we're in a bull market or a bear market, but it's going to be short enough that you can actually get some reactions versus like the weekly chart. It would be so delayed that you almost don't even have a market reaction. And then if you go down to an hourly chart, well, sure, it's going to be more reactive, but can you really tell if you're in a bull market or a bear market overall on an hourly chart? I would say not really. And so for me, it is best to be daily. And then, of course, I like to use it on the broad market index itself, because what I care about is what the broad market is doing. And then I want to align myself with opportunities that are in the same direction as the broad market on the individual stocks, versus looking at an individual stock independently and deciding whether that's in a bull market or a bear market or a sideways market. Robbie, I'm not sure which box you mean up. Do you mean the top label? Are you talking about this label up here? This, or are you talking about this box? Because this box is just my handwritten box. That's not from the indicator. The box is just the one that I have had drawn there for 3 months now, that I drew on TradingView. I just literally drew that. The indicator is just going to shade the background. It's not going to draw that box. Okay, so this is literally just my box that I drew. The indicator's not gonna draw the box. Maybe I'll do that. Maybe I'll have it find highs and lows and draw some boxes. Then we could actually trade real range breakouts and make it a little more actionable. Not a bad idea. Maybe I'll look at doing that as my next iteration. Okay, so now that we've talked about the regime matters, which I think everyone would agree, the regime matters. What are we in? A bullish, bearish, sideways market. Then the question is, okay, what do you trade in this type of market condition? Because most people are pretty comfortable trading a bullish market. You trade calls, and then if you follow me, maybe you trade debit spreads, and you trade them directionally. And if you're in a bearish market, same thing. I think most people feel pretty comfortable knowing if the market's going to go down, I'm going to buy puts, or maybe I'll do a put debit spread or call credit spread. But what about sideways markets? How do you actually manage sideways markets? And there's a couple different ways that you can do this. The way that I like to do it for a kind of discretionary sideways market environment is that I like to use an iron condor if volatility is a little bit higher, and I like to use a calendar spread if volatility is a little bit lower. Okay, so let's talk about how you would actually set that up. So if we look at setting up an iron condor, I'm going to use option strat just so it's a little more visual for you guys. And we wanted to create a scenario just using these actual levels. Let's actually go to SPX, because that's what I happen to have it on. Notice that I have the exact same box on SPX because, well, it's the same box. And we can see that our levels are right around 69.95 and 67.58. So right now on SPX high, I have 69.95. And then on the SPX low, I have 67.60. I'm just rounding to the nearest 5 there. And so then what we would do is we would go say, okay, how do I actually set that trade up using the proper trade structure? There's a couple things that we have to keep in mind as we look at trying to take advantage of a sideways market. The two biggest factors are going to be how big is the range and how much time are you giving it to stay in that range. So for example, let's just do an extreme one here. Let's go to tomorrow's expiration date and let's create a huge range on tomorrow's expiration date. Okay. So if I scroll that out, there you go. So you can see if I create that huge range and I give it basically no time, I have a very high probability of winning. It can move 3% in either direction tomorrow. But I have a very big problem, which is that my risk is 20 times my reward, right? Or even a little bit more than that.
Hey, before you go too far off, Nick was asking if you could explain what you meant by market squeeze.
Market squeeze.
Did you say something about it squeezing? Maybe squeezing the range real small there? I don't know.
Maybe when I say whatever, I don't know if I use that term. What I'm saying is if I open the range so that it's very wide on the actual structure of the trade, or I squeeze that range tight, that's what's going to affect the potential ROI, but it's relative to time. So I just want to give you a really, really clear example of how those extremes work. Okay. So notice if I say, hey, you can have a wide range, but I'm giving you no time to do it. Well, the market says there's a 98% chance of that happening, right? Would you guys all agree? Give me a yes in the chat. If you say, hey, listen, you can move 3% in either direction as long as you're within that range tomorrow, we're going to win the trade. That's a 98 or a 99% chance of that happening, right? Everyone agree with that? So because of that, the market's not going to pay us very much. We're going to have to risk $490 to make $5 or $8, right? Well, you could also then look at the very extreme opposite, where we tighten this range dramatically. We're at 68.50. So what if we go all the way down to 68.60 and 68.65, and we go all the way up here to 68.40 and 68.35. Well, now we can make a really nice ROI, right? We can make a really nice ROI, but almost every other scenario is going to be a loser. But the risk to reward has flipped dramatically. It was, we were going to have to risk 20 times our money. Now we can make, 6 times our money. Why? Well, because you're giving it a very, very narrow range. And so the market knows, in fact, OptionStrat puts it at 14%. It's very unlikely that the market is going to finish right here. And so because that probability is low, we're going to get paid a lot more. Now, here's the question. Because first, I'm going to give you guys some trade ideas here, or at least some structure on trade idea, and then maybe we'll do one trade. But first, I just want you to kind of think through the logical components so you understand that. And then you actually have the capability to structure these on your own using the criteria and the different, components the way that you think makes the most sense. So think about this. Tomorrow, we're giving it this very tight range. What if I give it until the end of the month and I go to set up the same trade, but instead of March 3rd, I go here and I set up this, 10-point range or whatever it is, 20-point range for March 31st instead of March 3rd. What do you think is going to happen to the risk to reward if I do that? Let me know in the chat. If I go from March 3rd, same exact trade, all the way to March 31st, what's going to happen to my risk to reward in that scenario? What's going to happen is that it's going to go from about a 5 or 6x to about a 50x or even a 100x, or in this case, a 200x. Now, these prices are jumping around, so it's not going to be perfect, but probably it's going to be like a 100x risk to reward. Now, that makes perfect sense because it's pretty unlikely that the market's going to finish right here tomorrow, but it's really, really, really unlikely that it's going to finish exactly right here 30 days from now. And the market knows that. And so it's going to reward you properly for it. I mean, this is one thing to keep in mind as you build any of these trade structures is that the market's pretty smart. It understands the logical components and the probability components, and then it demonstrates that in pricing. So just by looking at a very extreme example of if we went with a huge range tomorrow or a very tight range 30 days from now, we can see exactly how an iron condor works. It's going to reward you on the range relative to the time. So what we want to do then, using that very basic logic, is we want to build a trade that is going to find the correct balance of range and time. And so the way that I would typically do this is I would start with range, because to me, range is actually what you can look at a chart and feel confident. So I would start with this, like I typed in there, high of 69.95, low of 67.60. I would start there, and then I would see how much ROI can I get relative to the time that I wanted to finish in that range. Exactly what we did Friday on Closing Playbook, if you guys were there. So again, let's start with the range. Hold on, let me remember what my what my numbers were now that I'm not looking at my chart. Okay, 69.95 on the high side. And then 67.60 on the low side. One more. Sorry. There we go. Okay. Now I have this range really big, so it's going to look a little less attractive than it should, but it's going to look something like this. Okay. Now, one of the things that I hate about credit spreads in doing it with option strat is that it shows this as a 98% reward. It shows this as a 37% risk, which is really dumb. It should show this as 100% loss, and it should show this as a 300% gain. But for some reason, every broker is stupid when it comes to credit spreads, and even option strat, by taking the logic, becomes stupid as well. So really, you should look at this as 100% loss if it finishes out here, and this more like a 300% gain. Now, that is a really good risk to reward, and it looks like a really good trade. But remember, we have our date set to March 31st. So give me a yes or a no in the chat. I'm sure everyone feels comfortable that this is a pretty good range, but how many of you feel comfortable that you would trade this range all the way out to, let's find it, March 31 over here? So we're here right now. How many of you feel comfortable, yes or no, trading that all the way out to March 31st? If you do, it's a great trade. I personally don't. I feel like that is too much time within this range. And it looks like most of you would agree. Lots of no's in here. So again, 300% ROI, great. But now we're kind of in that balance that we're talking about. It doesn't make sense for time for most of us just because we don't think that we have another month left in this range. But if we just go all of a sudden to this Friday, right here, 4 more candles, how many of you feel pretty comfortable trading this range to this vertical line on March 6th? Give me a yes or no in the chat on this one. That's essentially 4 candles here on the SPY. Now, I'm sure we all agree we could get a breakdown any moment. Today's news could be a delayed catalyst where tomorrow drops 2% and we're well outside that range. Certainly can happen. But I think we all feel a lot more comfortable trading this range for 4 more candles on the SPY than 20 more candles on the SPY. And what's going to happen? Well, we're going to get paid a lot less for that trade, right? So when we go from the 31st to the 6th, now, instead of making 300%, we're going to make about 50% ROI. Now, I don't think 50% is bad, but it's a far cry from 300%. Okay. So I probably wouldn't take this trade at 50%. I would probably want to see 70 or 80%. But what we can do is we can just tack on some time and see, okay, when does it get more attractive? Well, interestingly, just by working in one more weekend, going from the 6th to the 9th, that's only one trading day, but it's over one weekend. Notice how this juices up to, 70 to 80% potential profit, right? Pretty good. I don't know about you, but going from March 6th just to literally one more trading day, you can barely even see the time changed. We went from a 45 or 50% ROI to a 75 or 80% ROI. Now, again, the market's not doing that because it's dumb. It knows that over the course of a weekend, we could see a big move. And so that extra volatility then gives us extra ROI. But for me, that's a risk I would be willing to take. Trade one market session for almost, double or 60, 70% more ROI on the exact same trade, going from the 6th to the 9th. And so this is probably the trade that I would take today. And we can set it up here in a second and look at it on Thinkorswim. But does that make sense? You guys, maybe some of you don't like the trade. That's totally fine. But are you seeing how we're combining range and time to get a balance that makes sense to us when we look at something like a neutral trade, an iron condor trade in this case? Okay, so good. So that is how you would set up a neutral trade using an iron condor. And like I said, for me, I would use the iron condor in a higher volatility environment. I would use the calendar in a lower volatility environment. Now, the reason for that is pretty straightforward. In a higher volatility environment, an iron condor is going to tend to give you a bigger range while keeping you with high profit. Why? Well, again, the market's not dumb. It knows in a higher volatility environment, it's more likely the market's going to move fast. Therefore, it's more likely that it's going to break out of that range. Well, you get paid for that likelihood by saying, listen, I know the market's high volatile, but I'm going to squeeze it into this range. In this case, 69.95, 67.60. I'm going to put it in this box, even though it's a higher volatility environment, and that's going to give me a higher ROI. Okay, so that's why I like iron condors in a higher volatility environment. Now, a calendar spread is going to work the same way in terms of wanting to have a net neutral market, but it's going to work very differently on the volatility side, because what you want for a calendar to work to your advantage is you actually want volatility to stay high or move up. Well, let me ask you guys a question. If we set up a calendar spread for next week and the VIX is at 22 when we set it up, what is the most likely scenario a week from now when we want that trade to remain neutral? All things being neutral, we started at VIX 22, we set up the trade. What is the most likely thing to happen a week later if the market is actually neutral? In other words, what we wanted to happen happened over the course of the week. VIX was at 22 when this trade began. Toward the end of the trade, if things are neutral, the VIX is likely to be lower. It's likely to be 19 or 18. Maybe it's likely to be 20, but it's likely to be lower. Well, the entire advantage of a calendar spread is that we actually want volatility to stay as high as possible. So starting out when volatility is high, in my opinion, is a disadvantage. Let me show it to you just by actually building it out. So let's build a put spread. This is a neutral trade here on SPX right around the money, and we could just do exactly what we were looking at before. Let's go to the 6th and the 9th. Okay, so exact same idea. We want the market to remain neutral. Actually, let's go to the 9th and the 10th because that would literally be identical. We want the market to remain neutral through March 9th. Identical scenario. as we just set up. Okay, and let's imagine that VIX is pretty high when we set up this trade. Okay, this is really attractive. You know, we can make a 500% return on our risk if we pin the price right here. Now, our range is smaller, much smaller, but the ROI is really, really good, right? So right now, I would say calendar spread versus the iron condor we just looked at are pretty comparable. One has a bigger range, one has a much higher risk reward, which is the calendar. So I would call them about even. The issue is, by the time we get to the 9th, if the market did stay very flat, the most likely thing is that the volatility came down during the entire trade. All right. And if that happens, well, you start to see exactly how your range would continue to shrink and how your ROI would shrink along with it. So for me, starting a calendar spread when the volatility is high and it's shrinking over time is the exact opposite versus the iron condor. It's exactly what I want. Volatility starts high, I get a big range. Volatility shrinks, the market stays quiet, iron condor crushes, right? However, flip it around one more time. What if IV is at 16? Well, we're going to get priced for IV being at 16, right? This is going to start out at 280%, 300% ROI. And then Iran happens and volatility shoots up, right? What happens if we set up a calendar spread for a neutral trade? Iran conflict happens, VIX jumps to 23 this morning, and then the SPY pops and it's only off by 0.2% from your middle line, like it is, or at least was. Now it's down 0.3, but whatever the case is. And we're, 4 or 5 days into the trade. Well, now you're seeing 50, 60, 70% ROI, not because you nailed the neutrality of the trade, but because the IV shot up during the life of the trade. Okay? So for me, 2 ways to trade neutral. There's more, but 2 main ways. One is calendar, one is iron condor, and they complement and work backwards from each other, where when volatility is high, I would use the iron condor. When volatility is low, I would use the calendar. When volatility is high and it gets low, iron condor gets better and better. When volatility is low and it gets high, calendar gets better and better. All right? That makes sense? Everyone following along there? So same box, same technical approach. You want the same thing to happen in the market, but you're just using a different structure with a different scenario, in this case, volatility, because that's going to dictate how much time, how much ROI you can get. All of those things are going to flow down from that market scenario.
Good job, man. That's a tough topic, but did a good job.
Yeah, that's a little bit complex, and I'll do a slideshow version of this and give you some more rules. But for now, we can actually look at our iron condor, which I thought I could get back to, but I guess I can't. And see if we can set it up. Let's see, 67, 60. Is that where we're at? Or I forget my numbers every time I pull this up, but
I was doing too many things to remember what they were. Sorry.
Yeah. That is.
Hey, way to get our brains going on a Monday morning.
Yeah. Well, there you go. So this is the one that I liked. It was the March 9th, using that extra weekend. Still creates a pretty big range, about a 2% range to the upside, about a 1.5% range to the downside, and should pay us around 70 or 80% ROI. Again, I hate how they do the credit spread math. It drives me crazy every time. But let's look at it. Someone asked about a reverse iron condor. Well, I'm sure the reverse iron condor would pay out quite nicely right now. The problem is I wouldn't really have much faith in it working because I wouldn't have much faith in the breakout happening in the short term. All right, let's go ahead and set up. Now, you guys, by the way, you can do this as a credit spread or a debit spread if you want. I like the credit spread because in this case, you're actually planning on letting it expire. And so for me, the credit spread makes more sense. So how we would do this, we would go to the call side. We'd go all the way up to that 69.95 level way up here. Okay. And the first one we would do is we would sell it. Now, the reason we're selling a call spread is because we want it to finish lower than 69.95. And a call credit spread is bearish. It means I want you to end up below this lower number. So we'd start there by selling it. And then we'd scroll all the way back and we'd sell the put side on that lower number, which I forget again, 67.60, I think is my lower number over here. All right. In this case, we might actually be able to get our 100%. Let's see if we can actually get filled here. So we can actually get filled maybe a little bit better. I'll try at 255. That's the mid price is jumping around. But in this case, the more credit you get, the better. Okay, so credit spread, more credit is better. And let me see if we can. That's pretty wide bid ask for SPX, but we'll see if we can get filled here. It's showing up to 265 mid. We'll leave that on.
What'd you put it in for?
I put it in for 255. Okay. The mid's like literally jumping like crazy. So we'll see what we actually can get filled at. But again, if you guys want to look at the trade visually, this is what we're building. Okay. And you can see with an iron condor, all things being equal, we're not going to see a ton of profit early into the trade. We're going to have to wait. But one thing to note is that if the volatility does come down, like I said, it's the opposite of a calendar. The profitability gets more attractive, not less attractive. And that's one of the things I love about the iron condor. If volatility goes down, I can trade it when it's high. And while it comes down, I get more profitable versus most trades. Volatility is working against you because you paid a high price when volatility is high. Now you have to suffer that premium. Here, volatility going down is our advantage. Looks like we're going to be more around 235 or 240, but honestly, that's still better than what we were actually quoted on the option strat. So we're still actually looking a little healthier, even if we get in for 230, 235. Mid price still showing 260 some of the time. Wish it would fill for that. 260 would be amazing. I'm going to crawl it down to 235. And it filled. Okay, so 235. So just to wrap us up here, we can make $235 on $265 of risk, 88.6% ROI on that. I think that's pretty great for that big of a range. We want it to be here. And again, one thing to keep in mind, let's say the market jumped, it's up 1% tomorrow. It jumps all the way back up here. We're still in the middle of the range, but the VIX drops, volatility is lower. You might want to close half your contracts early. Grab 25%, grab 30% if you get that advantage early in the trade. So there you go. Hope that was helpful. Graham, I feel like I have set us up with, the exact opposite of the potential that we're talking about. I'm talking about boring premium selling, and I know you're going to shift gears in a big way here.
Well, first, let me just throw a caution flag out here. Tom said, "What if you reverse and sell a calendar?" Please don't do that. We don't do credit spreads on calendars, do we?
I guess you could. I've never really actually done the credit version of a calendar.
I don't think so.
I guess you could technically get but your the advantage of IV going down.
Risk is going to be open-ended. You can have an open-ended risk. It's not going to be risk-defined.
Yeah, but theoretically, the other option would still control. I've never actually sold a calendar.
Yeah.
You just you can't let your short-dated leg expire.
Right. It would still be somewhat controlled. It would be a little bit unknown because of the, because again, IV could change, but yeah. I don't. I,
We should look
maybe
into that for fun.
Yeah,
Yeah, but
yeah.
but the price action could still kill you, even though you're not primarily trading on price action. If the stock shoots up, you're gonna have a
Right,
little bit of risk.
but then your other option will change with it. So like again, you're still going to have that kind of control as you go up and down. It's just not completely known.
Yeah, and it's definitely a little bit different because you're going to be your short dated one's going to be the one that controls
Right,
your risk.
right.
So if something crazy happens, your short dated one, you exercise it, and then something crazy happens the next day, they could get a little bit wonky.
Yeah,
So that's a
I'll mess around
to
with
flag
it.
that, David.
It's a good question. I'll mess around with it. I've never traded a short calendar, so
There's so
maybe
many
I'll.
combinations we can try and test.
Right.
Yeah, well, I've got Chris Palmer telling me about jade lizards. I'm like, all right,
Right.
I haven't even I haven't even figured out the calendars yet. Let's chill out with lizards.
I'll sell you my reverse calendar for your. I'll trade you my reverse calendar for your upside down broken lizard.
Yeah.
Exactly.
Yeah.
Sorry, Graham, I didn't mean to.
Oh no,
cut you
you're
off.
good. You're good. Nate, I do think that's a good approach to be taking for the S&P, right? Or any range bound name. Now there are names. Actually, let's look at like names that are moving today. Actually, we had Hershey's up here. It looked really good. I was going to show it to you guys. CVS going for a gap fill. A lot of board picking it up. So even though the S&P has been range bound, where did my Hershey's one go? Let me just search Hershey. There are names that are moving. These very exciting stocks like Hershey's. Who's probably an AI company by now.
Yeah.
See if I can get this to load. But here in just a moment, I'm going to show you guys how we are using the current movement of stocks, kind of like Nate did. He said the current movement of the S&P is flat, deadlined, so we'll take advantage of that. We're looking kind of for the inverse, where stocks are moving in one direction or the other, and then the options are currently underpriced. Now, I was going to show you the one in Hershey's, but I just got a refresh on my lotto board. It like CVS right now, which I like too. 203% for a 4% move on CVS for that gap fill there. Nice little opportunity on CVS. Let's see, Walmart here. Let's see what the 200% on Walmart if it gets to that yellow line.
Oh, dude, I love Walmart.
Look at that. I mean, that is not a big move at all. That's a 3% move in Walmart. 200% payout. Beautiful trend. Does not look like the S&P. The S&P looks terrible. Walmart looks amazing.
3% move in 18 days. We're not talking about tomorrow.
Right. 3% move in 18 days pays 200% on Walmart. And this is our safe. I mean, look, it doesn't even have to make to all-time highs. It has to get about, what, 70% of the way there. 3% move. Now, what's cool, I'm putting together right now the masterclass slides for the lotto board. We're going to dive into it tomorrow. I'm going to walk you through it step by step. Nate, if people felt like they were a little bit confused today, wait till they see what's going on tomorrow behind the scenes with the lotto board. We got a lot of fun stuff to uncover, unpack. The good news is the lotto board, I'm going to show you step by step how it works. This thing does it all automatically for us, where we can find these kind of opportunities for outsized returns, even on a very normal move in the stock. The crazy thing here with this Walmart one is it's currently moving at a 5.5% pace, meaning if it just does what it normally does over the next 18 days, Walmart will be up likely around 5% or so. Market makers, a little bit cheaper than that. The crazy thing is we're going to get our payout even if it underperforms both the calculated move and the market maker. I love it when we get a setup like this where our percent to hit is less than both calc move, which, I mean, this is where it's most likely going to end up based on the current movement of the stock. This is what the market makers think is going to happen. Here's what all we need to happen for a 203% payout. So we're going to walk you guys through this.
Hey Graham, in your class, you got to check out Google with the members, because I have an insider tip on Google. It's very, very secret backdoor tip. Here's what it is. Claude is down today. I don't know if anyone knows that.
Uh-huh.
And so I went to ChatGPT and it worked fine. And I went to Gemini and it said overloaded. So clearly with Claude down, people were moving to Gemini and not ChatGPT.
Interesting. Gemini
that's your insider tip.
Eating market share. Look at this one.
Do you want me to post that? Do you want me to post the Walmart one?
If people want to, yeah, sure. Did you grab it?
I did.
Oh, cool.
Oh,
yeah, throw
quick.
it in there for fun. You just said Google. Funny enough, Google is popping up here, number 2 on our lotto board. The more moderate approach, almost 300% payout on Google. It's got the whole month to get to that yellow line. I mean, that is like it could sneeze one day and get there to that yellow line. It's currently moving at a 7.6% pace. I'm going to walk you guys through how we calculate that, the blocks it uses to get that average move or that projected move. Market makers are pricing in a 7% move in Google over this month. We only need 6.8% not to double our money, not to get 150%, nearly 300% ROI here on a very, very normal move in Google. Now, if you guys want to get real crazy, there's some other ones out here like analog devices. I just tried to get in on this one. Currently trading at the cool thing, I can get live prices. Currently trading at 15 cents. This isn't, a more extreme. This is a true lotto style pick here, but look at this. How many of you guys have ever landed 1,000% return? Hopefully you have if you took the CLSK trade with us a few months ago. Hopefully you got 1,000% return. It's not very likely. Most people don't see 1,000% returns. I had never seen 1,000% return, Nate, until we started working on this lotto board. Here's what an analog device is. Based on the current movement, look at this chart. That does not look like the S&P. This thing is a steamroller. Based on the current movement of the chart, current trajectory, analog devices, ADI is on pace to move 8.7% over the next 18 days. Market makers have it trading for cheaper. The options are underpriced relative to the current movement, the current trajectory of the stock. That's our opportunity. Here's the crazy thing. We only need analog devices to gain 6.8%. Again, not to double our money, not to make 300%. 1,567%. That's an absurd return on a stock like this. You put $100 in, you're walking away with $1,500. You put 1,000 in and it works, and we're assuming it works. We need it to work out. 1,000 in is $15,000 paid out in profit. So that's the kind of opportunities we're looking for here today. While the markets may be dull, as you can see here, as I showed you, I didn't get to pull up Hershey's. It went away, but Walmart, beautiful trend. ADI, does not get any prettier than that. And we're getting outsized, crazy returns. We also have some downside ones, which we'll walk through today as well in the class. Look, I don't know if this is going to be legit. Let me refresh it. 233. But again, hood to fall 3% over the next month pays 233%. See that red line there? Let me zoom in. That's all it needs to do. It needs to just be where it was at the open today to get 233%. That's insane. So while the markets may be dull, stocks are moving, individual stocks are going in either direction. We're going to pull up the lotto board class right now to walk you through how this tool works. Of course, I just walked through the more complex version of it. Each day, it just gives you the top 3 bullish, top 3 bearish. There's the hood one, and you can rock and roll from there. So we'll get that up for you guys. The members class will be tomorrow at 12:30. 12:30. So make sure you stick around. Check this out. Get the lotto board in your hands. There's a getting started video for you. It'll walk you through how to just use it starting today if you want to. And then tomorrow at 12:30, bookmark it in your calendar. We'll do it live together, and that will be recorded for the members.
0.9% win rate on home run trades, just insane. 143% is the average return, folks. That's the winners and losers combined over 10 days, with the average winner of 224% and the highest profit factor I have ever seen in my career right now at 10.45 on those real money trades over the last few months. But of course, bound to be winners and losers. This is a tool for traders. It's not a trading service. So of course, your performance is going to vary on how you use the tool. Trade at your own risk. Again, let's just double and triple down here so everyone's on the same page. We have seen this tool produce really big wins, and that's by design. It's looking for those huge 500, even 1,000+% potential lotto-like setups. That's why we nicknamed it that, and has become the real name. And so, of course, there have been some of those big Grand Slam results in the past, but keep in mind, not every trade's going to end up being that big. Plenty of trades are smaller, 50 to 300%. Average win 224, and then of course there's some losers as well. That should be expected, and we're just going to walk you through all those stats today in the class, so there's no confusion about the typicality seen so far from those real money trades by the myth, the legend himself, Graham Lemon. And so again, just like I said, triple down. I want to be very clear here because we're going to show you some amazing stuff, and I just want to be clear: no black box, no miracle, no magic money printer. We are trying to give you an edge. This might be the biggest edge we've seen so far, but it doesn't mean it's guaranteed. It doesn't mean it's automatic. If you can't handle losing trade,
Obviously, you should not trade with real money. So again, losses in trading have occurred and will occur. Hopefully, we've done our due diligence to be very, very clear on that front. So welcome, guys. I'm Nate Tucci. If you don't know me, I'm the publisher here. And the question for today is, what if you could throw out all your charts